In 2008, AIG was one of the largest insurance companies in the world, but within days it required an emergency bailout to avoid total collapse. That moment mattered because AIG was not failing from traditional insurance losses, but from a financial system it had built inside its derivatives business. Through its financial products division, AIG had sold hundreds of billions of dollars in credit default swaps, insuring complex mortgage securities. That exposure mattered because these contracts required collateral when asset values fell, turning market declines into immediate cash demands. When U.S. housing markets began collapsing, the value of those insured securities dropped rapidly, triggering escalating collateral calls. Those demands mattered because AIG did not have the liquidity to meet them, even though its balance sheet still appeared large. As counterparties lost confidence, funding access tightened, accelerating pressure across the system within days. That reaction mattered because AIG's failure would have transmitted losses across global banks holding those contracts. Within weeks, a $180 billion rescue became unavoidable, proving the system itself had created a failure too large to absorb. In September 2008, AIG faced escalating collateral calls exceeding $30 billion as the value of mortgage-linked securities continued to decline. That surge mattered because these payments were immediate cash obligations, not long-term losses, creating a sudden liquidity crisis. The company's financial products division had written credit default swaps on over $440 billion of assets, including subprime mortgage securities. That scale mattered because even small percentage declines in asset value translated into massive collateral requirements. Credit rating agencies downgraded AIG after recognizing the growing exposure, triggering additional contractual collateral demands. That downgrade mattered because it accelerated the crisis, forcing the company to post even more cash at the worst possible time. Traditional insurance operations remained largely stable, but they could not generate liquidity quickly enough to offset the derivatives pressure. That mismatch mattered because AIG's risk was concentrated in financial products, not its core business. Within days, the company moved from strained to critical, leading directly into how this exposure had been built over time. AIG's financial products division had been built to generate steady income by selling credit default swaps on highly rated securities, assuming default risk was minimal. That strategy mattered because it treated rare events as negligible, allowing the company to collect premiums without setting aside sufficient capital. Most of these contracts were written on AAA-rated mortgage-backed securities, which were widely believed to be low risk before 2007. That assumption mattered because it justified writing large volumes of protection without fully accounting for correlated housing declines. Unlike traditional insurance, these derivatives required collateral posting when market values changed, not just when defaults occurred. That structure mattered because it transformed long-term risk into immediate liquidity pressure during market stress. AIG did not hedge much of this exposure, relying instead on the belief that housing markets would remain stable. That decision mattered because it concentrated risk without protection, increasing vulnerability to systemic shocks. By the time housing prices began falling, the system was already positioned to convert declining asset values into accelerating cash demands. As U.S. housing prices began falling in 2007, the value of mortgage-backed securities dropped sharply, directly impacting the assets AIG had insured. That decline mattered because it triggered mark-to-market losses, forcing AIG to recognize valuation changes even before actual defaults occurred. Counterparties began demanding collateral as the perceived risk of these securities increased across the market. That shift mattered because collateral requirements rose rapidly, converting paper losses into immediate cash obligations. AIG's models had not accounted for a nationwide housing downturn, assuming declines would remain isolated and limited. That assumption mattered because it underestimated correlation risk, allowing exposure to grow unchecked across similar assets. Internal warnings emerged about the scale of potential losses, but the positions were too large to unwind quickly. That constraint mattered because it locked the company into a deteriorating situation with limited exit options. By late 2007, the system had already entered a phase where declining asset values would continuously trigger escalating liquidity demands. By early 2008, collateral calls against AIG were accelerating, with billions required as counterparties reassessed the risk of insured securities. That escalation mattered because each downgrade in market value increased immediate cash demands, tightening pressure on available liquidity. The company attempted to reassure markets, but disclosures revealed growing losses tied specifically to its derivatives exposure. That revelation mattered because it shifted perception from contained risk to systemic vulnerability within AIG's structure. Credit rating agencies issued further downgrades, activating additional collateral triggers embedded in swap agreements. That trigger mattered because it created a feedback loop where declining confidence directly increased financial strain. AIG sought private financing to stabilize its position, but potential investors were deterred by the scale and opacity of its obligations. That hesitation mattered because without external capital, the company had no buffer to absorb ongoing demands. At this stage, the crisis had moved beyond management control, pushing the system toward a point where collapse became unavoidable. In September 2008, following the failure of Lehman Brothers, financial markets entered a phase of extreme stress, sharply increasing pressure on AIG's positions. That shock mattered because it caused a rapid repricing of risk across mortgage-related assets, triggering even larger collateral calls. Counterparties demanded additional billions in cash within days, far exceeding AIG's available liquidity. That demand mattered because the company could not convert its long-term assets into cash quickly enough to meet obligations. Short-term funding markets froze, removing AIG's ability to borrow against its balance sheet. That freeze mattered because liquidity, not solvency alone, determined survival during financial crises. Internal options narrowed, as asset sales would have locked in massive losses without solving immediate cash needs. That constraint mattered because it left no viable private solution within the available timeframe. At this point, the system had crossed its point of no return, forcing authorities to prepare for direct intervention. On September 16, 2008, the Federal Reserve intervened with an $85 billion emergency loan to prevent AIG from collapsing. That intervention mattered because AIG's failure would have transmitted losses across major global banks connected through its derivatives contracts. The rescue expanded over time to more than $180 billion, making it one of the largest bailouts in financial history. That scale mattered because it reflected how deeply AIG was embedded within the global financial system. In exchange, the U.S. government took a nearly 80% ownership stake, effectively nationalizing the company. That ownership mattered because it ensured control over restructuring while protecting the broader financial system. Funds were used to meet collateral obligations and stabilize counterparties exposed to AIG's contracts. That stabilization mattered because it prevented a chain reaction of failures across interconnected institutions. What had been a private risk system was now supported by public capital, leading directly into long-term consequences and reforms. In the aftermath, AIG was restructured through asset sales and the gradual unwind of its derivatives exposure, reducing risk across its balance sheet. That process mattered because it transformed a system built on concentrated financial risk into a more controlled and regulated structure. The U.S. government ultimately recovered its support with a profit as assets were sold and markets stabilized over time. That outcome mattered because it demonstrated that intervention prevented systemic collapse while allowing eventual financial recovery. Regulators introduced stricter oversight of derivatives markets, including central clearing and higher capital requirements. Those reforms mattered because they aimed to reduce opacity and limit the buildup of similar systemic exposures. The crisis highlighted the dangers of assuming low-probability events would not occur across correlated markets. That lesson mattered because it reshaped how institutions evaluate tail risk and interconnected exposure. AIG became a defining example of how a hidden financial system can scale beyond control, proving that liquidity pressure can collapse even the largest institutions.